Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm once again sorry for the technical delays in getting things actually up off the ground. If you just bear with me 1 second now. Just want to double check, which you should be able to see. In a second now, you should be able to see my shared screen, which is essentially basically it's showed up yet. Oh, there you go. So we can now see. I hope you can all see. Once again, we're going to start off with the US 500. Apologies for the delay in beginning. My name is Dave Madden. I work as a market analyst for Equity Capital here in London, and Equity Capital is one of the kind of many companies within the overall equity family, including FXPesa in Kenya, and we've also operations in the Middle East as well as Latin America. So get things going. First things first, we look at the US 500, and it's been a roller coaster ride for the financial markets in general, but most importantly for the US market in the past 24 hours. Last night, we had a dovish hike from the Federal Reserve. They hiked interest rates by 75 basis points, meeting expectations, number one. But number two, they also said that they might look to actually even though further rate hikes are in the pipeline, they might look to scale back the size of those rate hikes, looking, months and quarters down the line. And the very mention of the fact that they might be looking to implement smaller rate hikes towards the end of the year gave off the suggestion that perhaps we might be over the worst of the large interest rate hikes, possibly, or gave off the impression they're at least already thinking about ending the aggressive hiking policy. Therefore, we might be already at the halfway mark, or we may be even at the gradual kind of going downhill mark. That's number one. Number two, so first things first, we saw a fairly large rally in US stock markets last night. On the back of that, strong gains were posted last night. People think that as a sign the Fed aren't going to be as aggressive as originally thought, number one. And then earlier on today, we had the advanced reading of the US GDP for the second quarter. And economists were expecting growth of 0.3%. It came in as a decline of 0.9%. It actually contracted by almost 1%. So it was way off the initial reading, way off estimates. And with that, and on top of that, we had the first quarter GDP number was actually revised lower to negative 1.6%. So it's a double whammy in both counts. And for those of you who know your economics, two consecutive quarters of negative growth constitutes a technical recession. So there's already kind of talk in the markets. Could the United States be in a technical recession? Now, to be fair, there's any chance in the world that the negative reading for the second quarter could actually be revised higher at future updates, future revisions. But for the time being, it looks as if the United States is in a technical recession. And guess what? Even though it did apply a bit of pressure to stock markets in the United States, we actually moved on to session highs, because it seems to me that we've kind of fallen back into the kind of old bad attitude of good news is bad, bad news is good news, whereby bad news for the economy, i.e. the economy is in a recession, is actually good news for the stock market. Because guess what? If the United States actually is confirmed to be in a recession, how many more interest rate hikes do you think we're going to have from the Federal Reserve? In the past 10 or 12 years, stock markets have become addicted to ultra loose monetary policy from central banks, be it in the form of asset purchases schemes, or perhaps even relatively low interest rates. The minute it looks as if the economy is hitting the skids, central banks either cut rates or else they announce quantitative easing schemes. Now, even though until very recently the Fed have been very aggressive with their language and on the talk and their actual actions in terms of hiking rates, now we could be at the point where, well, if you're in a recession, how many more rate hikes are we going to have? So, like I said, it's an odd scenario whereby talk of a technical recession in the United States has actually pushed the US 500 to its highest level since early June. So we're talking, not too far away. We're talking about a 6-7 week high being racked up on the US 500. If we take a look at the MACD indicator here, we can see momentum has swung from negative territory to positive territory, indicating that the bulls are in control. While we continue to hold above these three simple moving averages, it's likely the more medium-term upward trend will continue. A break higher from here could see it retest 41.44, and a break beyond that could see a target 41.89. Just to kind of point out here on the RSI, the relative strength index, we can see here that that's actually moved into overbought territory. So it could already be a bit of a flash warning that the upward moving price has actually become overstretched. So there are already kind of brief concerns. The upward move here has become overcooked, as it were. So if it turns out that we do see a bit of a pullback in the US 500, where can we target? Well, I'll be looking down towards this moving average here, which is the 50-period moving average, and that comes into play in around 39.48. And if we break below that, we could see it retest this zone here around 39.10. Now, I should have mentioned from the outset, looking at the charts here that I'm looking at, this is a 4-hour window, a 4-hour time frame that I'm looking at, and the three different moving averages I'm looking at is first and foremost the 20-period moving average, then the 50-period moving average, and then the 100-period moving average. Now, the reason why I selected the 50-period moving average was if you follow it around, you could see it sort of acted as a support here only a few days ago. If you follow it around even further, it acted as support here, bit of a consolidation zone here, and acted as support several times here, and as resistance here. And as I often say, if a metric has been of importance in the past, it makes it more likely to be of importance in the future. But as I mentioned, for the time being, the big picture trend for the US 500 is to the upside, but I'm just pointing out that in the short term, I would not be surprised if you see a bit of a pullback, given that the RSI has moved into overbought territory. Coming on now to the UK 100, the FTSE 100. The UK 100 has received a bit of a lift because of what's going on with the US 500 and kind of sentiment across the board with stock markets. But the extent of the lift hasn't been as impressive. But nonetheless, if you look at the price action here, we can see the UK 100 has been trending higher recently. In the past, 12 to 16 hours in this session, we've seen the market peak and it hit its highest level since early June. So once again, we're up around 6-7 week highs on the UK 100. That in itself, the fact that we're hitting multi-week highs tells you how bullish sentiment is. And if you continue to hold above these three simple moving averages, we're off the recent peak, but we're still back above all three moving averages. If you continue to hold above all three simple moving averages, it's likely the more medium-term upward trend will continue. A further rally from here could see a target 74.50, and a break beyond that could see a target 75.24. Now, if you take a look at the price action in the past 8 to 16 hours, we can see the market has retreated from its recent peak, which, by the way, was a 6-7 week high. If you're looking at the MACD indicator, we can see momentum has swung from positive territory to negative territory, so it now suggests that the bears are in control. We've seen a bit of a dip in the RSI, in the relative strength index, suggesting that a lower RSI typically suggests the price bias is to the downside. So we could potentially, and if we do see a further decline in the UK 100 from here, support might be found from this simple moving average here, the 50-period moving average. It acted nicely as support here, sort of acted as support here, acted as resistance zone all along here. And that moving average comes into play at 72.86. And a break below that could see us retest this simple moving average here at the 100-period moving average, and that comes into play at 72.20. One of the aspects of technical analysis, charting, is what I like to look at, is Dow theory. And one of the tenets of Dow theory is that the averages must confirm each other. And what that means is that essentially markets that are quite similar to each other should, in theory, be moving in a similar direction at the same time, and possibly even by a similar amount as well. So as soon as I opened up the chart of the UK 100, the first thing I said was, It's trending higher and it recently hit its highest level since early June. So what did I say about the S&P 500? It's trending higher and it's recently hit its highest price since early June. So the commonality between the two isn't exactly a coincidence. Stock markets around the world, with broadly speaking, moving kind of in similar direction, unless there's something very unique to a certain country or a certain region. But typically speaking, stock markets around the world often move in tandem with each other. So if you're a person who trades, you say regularly trades the UK 100, but you never really trade US markets, that's fine. But at the very least, I would recommend keeping an eye on what's going on with US markets, and vice versa. If you only trade the S&P 500 and you never trade European markets like the FTSE 100, fine. But at the very least, if you've taken the view that, for example, you might think that the US 500 is going to continue to rise from here, if you see other similar stock markets, other US indices, equity markets in Asia, equity markets in Europe also moving higher, you can then be more confident of that original view that the S&P 500 is going to move higher. There are no guarantees. This is why trading is tough, but this is one of the elements of Dow theory. So I've talked about the kind of overall risk on moving the markets. I've talked about the dovish hike from the Fed carrying out their dovish hike. We did see a lot of volatility in the US dollar in the past 24 hours for similar reasons I've mentioned. Last night we had the dovish hike, so we did broad sell-off in the US dollar, and then today we saw a large portion of the dollar's losses from last night be recouped. So we saw the US dollar rallying for the first half of today. Then lo and behold, we have those quite grim GDP figures from the US, and on paper, in theory, the United States is in a technical recession, but that may change depending on any potential future revisions to the second quarter GDP reading. So we saw another move to the downside. So the dollar sold off aggressively last night and rebound this morning, and it's turned a bit lower again. So overall, the result was dollar crosses, euro dollar higher, pound dollar higher, Aussie dollar higher, and the likes, dollar yen lower. So you can see here in the price action, GBP USD, the British pound versus the US dollar, hit its highest level since late January. So essentially hit a 1 month high on pound dollar. That's pushing higher. The fact that we hit a 1 month high in itself, that kind of headline speaks to how kind of strong the currency pair has been recently. Where even though we've pulled back a small bit, we're still holding above all three of these simple moving averages. And while we continue to hold above all three of these simple moving averages, it's likely the medium-term upward trend will continue. A further rally from here could see a target at 1.2283, and a break beyond that could see a target this zone here at 1.2331. Now, I mentioned about how we've had a bit of a pullback in GBP USD. If you take a look at the market indicator, we can see that momentum continues to be in positive territory, but there's been a steady decline in positive momentum. So essentially saying the bulls, the buyers, they're not as influential as they once were, and they could be losing their grip. It's often kind of a tussle between the buyers and the sellers, which way in terms of who's the more powerful, who's the more influential. The bulls are still influential for the time being overall, but their kind of power in the markets, influence in the markets is waning. So that could be an early sign that we're going to see a bit of a pullback. And let's face it, if you kind of monitor previous price action and use that as a predictor for what we're going to see in the future, we could see we could see further losses to come for the GBP USD. For example, we saw a fairly large pullback of the currency pair here. We saw a very large pullback in the currency pair here, despite the fact that we're in an overall upward trend. There are numerous occasions where the market, enjoyed a rally here, pull back to here, enjoyed a rally here, pull back to here, enjoyed a rally here, pull back to here. And in fact, if you look at this trend line that I just drawn on here, from the lows here of mid-July through this low here around July 21st to this low here around July 27th, this is a confirmed trend line, because a confirmed trend line has 3 points or more, and whereas a tentative trend line only has 2 points. Now, my longer, more kind of broader term view is that while we continue to hold above all three simple moving averages, and especially while we continue to hold above this trend line here, I think the more medium term upward trend for the GBP USD will continue. who knows? There's been a few occasions where the market has enjoyed a rally, only for it to pull back to retest the trend line before it rallies again. That's happened a couple of occasions before. It might happen again. If you do see a move to the downside in GBP USD, where can we target? Well, potentially this trend line itself. But if you break below that, we could look to head back all the way down to this simple moving average here, which is the 50-period moving average, and that comes to play at one spot 2030. And a break below that could see us back all the way down to the 100-period moving average in at one spot 1964. Coming on now to gold. So for those of you who trade gold, I'm sure you know already, but in case you don't, if you trade gold, you always should be keeping an eye on what's going on with the US dollar. Gold is listed in US dollars, and whenever the dollar is weak, that typically pushes up the value of gold. And conversely, whenever we see a rally in the US dollar, we typically see a weakness in gold. Not always, but that's what it's broadly been like recently. So I'm mentioning the weak US dollar over the past 24 hours. Is the United States in a recession? Could the Federal Reserve at their next meeting signal that they're actually going to wind down the rate at which they're going to hike rates? Will they suggest they're going to stop rates? The dial is kind of shifting in that direction. And with that, we've seen weakness in the US dollar. And the weakness in the dollar has driven up gold. We can see here that gold has enjoyed a sharp rally in the past 24 hours, back up to a level last seen in early July. So we're talking, multi-week high, 3.5, 4-week high being set in gold. That in itself says a lot of I'll buy. We've gone on to hit a 3-week high, nearly a 1-month high. Looking at the MACD indicator, we can see the momentum swung from negative territory to positive territory, indicating that the bulls, the buyers, are now in control. While we continue to hold above these 3 simple moving averages, it's likely the more medium-term upward trend will continue. Further rally from here could see it retest 1772, and a break beyond that could see a target at 1786. And then, of course, if we go beyond that, we could be looking at heading back up towards 1800. That's the next big kind of psychological number. Looking here at the RSI, the Relative Strength Index, we can see it's moved aggressively higher, and in fact, it's actually moved into overbought territory. So that could act as a bit of a flash warning to suggest that the upward movement price has become overstretched. And if you do see a move to the downside, which could lead to a bit of either traders who are already long closing out their long positions and selling gold, or could entice some people to open a fresh short position. So either way, the RSI could act, the fact that RSI is now overbought, that could act as a sign that the upward moving price has become overstretched and might lead to a pullback. If you look at the moving averages here, we have all 3 moving averages: the 20-period moving average, the 50-period moving average, and the 100-period moving average. They're all seem to be coalescing around this zone here, around 1724, 1725. And whenever you have a number of moving averages coalescing on each other, it usually indicates there recently has been some consolidation, or our market's been trading in a tight range, which has been the case. So this zone here could act as support if we do see a very large move to the downside. So watch out for 1724 if you see any losses on gold. And if you were to break below 1724, we could then be looking down towards 1700, 1703. Now, I realize I've been talking on now for a few minutes. If I have any questions about what I've been covering, or are there any markets that I haven't covered that you want me to take a look at, feel free to get in shout, to just type away. Just put there in the chat box saying any questions, any markets to look at. Happy to quickly analyze, quickly talk about any of the major markets, or any market at all really. I usually just on these events usually talk about the major markets, because I know clients like the likes of big indices, big currency pairs, and commodities. And speaking of commodities, I'll now take a look at what's going on with UK oil, Brent crude oil. Now, to be fair to it, Brent crude oil has been one of the more Judging by the standard of the last couple of days, has been one of the less interesting markets to trade. What's been going on with UK oil? Well, in the kind of big picture, in the really kind of grand scheme of things, we have seen a lot of weakness in the oil market. We can see here, it's been a clear example of lower lows and lower highs. In fact, the lows that we saw in mid-July were basically back down to, I think it was 5-month lows were printed in July. And this was a few weeks ago, whenever it looks as if the global economy was cooling. The global economy is cooling. We very recently had the IMF this week come out and downgrade its growth forecast for Germany, the United States, and also China, so some of the biggest economies in the world. They also said that the chance of a global recession have increased. Not that the global economy probably, for the time being, doesn't look as if it'll actually go into recession, but the possibility of recession seems to have increased. So that really weighed on oil. But what we've seen in the last week and a half, 10 days, has been a ratcheting up of tensions between Moscow and Brussels. Now, essentially, some Eurozone, some EU countries such as Germany and Italy are major importers of Russian gas, which kind of fuels their economy. But now we've had kind of more bouts of gas shortages from Russia into Western Europe. The European Union are kind of making preparations for gas shortages and cutting back on consumption. And with this, we're kind of seeing we've even had points where there's been an intentional there has been a sizable drop off in gas supply from Russia into Europe. Some days 20%. And with that, we've seen very volatile natural gas prices, and the natural gas prices have led to kind of a pushing up of UK oil. So concerns about supply of energy across the board, especially, I know we're in summer now, but autumn isn't that far away, and then the winter will be far behind it. There's talk that the global economy is cooling. We could be looking for, at the same time, we could be looking for a energy squeeze in terms of shortage. So we have seen a bit of a move to the upside in the last few weeks. Note how the peaks that we set in the past 24 hours are essentially on par with the highs of last week. We haven't even got really kind of close to retesting the highs of mid-April, mid-July. So I'm still kind of cautious of the kind of big picture trend is to the downside, but at least in the very kind of short term, a much more kind of short term trend for UK oil is very much to the upside. You can almost just draw a trend line here. It's not perfect, it's reasonably good. And then once again, drawing trend lines, like in anything in technical analysis, is subjective. You could argue that is a confirmed trend line and probably continue to hold above that trend line. It's like it's a more medium term upward trend in UK oil will continue. Even though we've pulled back in the last few minutes, last few hours, we're still holding above all three simple moving averages. And between holding above the moving averages and holding above the trend line, it appears the kind of broader upward trend is going to continue. So if we do rally from here, where can we target? Well, I've been looking up towards this peak here, the peak of the early July in around 105 spot 95. And if we go beyond that, we can be looking up towards 111 spot 23. Like I said, there are always kind of trends within trends. So I talked about how the more medium term trend is higher, but let's not forget, once again, this is far from perfect. Let's not forget that the kind of really big picture trend over the last month is very much to the downside. So if UK oil fails to kind of break higher and break above this peak here around $106 a barrel, that could be like an early warning to suggest the much longer term downward trend is still in effect. If it do move lower on UK oil from here, where can we target? Well, I'm looking back down toward this zone here at 96 spot 92, and then below that down towards 95 spot 61. So these are the areas I'm looking out for should we see a fairly large drop off in the price of UK oil. So once again, let's kind of throw the door open to any questions. If not, I'd like to wrap things up fairly soon. What charts am I looking at? Well, I'm looking at 4-hour charts here. For the sake of this kind of webinar, I'm looking at 4-hour charts. I'll quickly get a flip over to other charts. And if you can get a chart in itself will tell you a lot what's going on. So if we take a look at, for example, the daily chart. If we look here at the 4-hour chart, the one I started off with, we can see that the kind of broad picture for UK oil is to the downside. Although we have seen a fairly large upward move here, in the grand scheme of things, the market went from all the way being up here to down here, followed by a rebound from down here to up here. So the long-term view is to the downside. And let's face it, this upward move here is very small when compared to all this downward move that we saw here. Whereas if you look at a 4-hour chart, you'll say, okay, broadly speaking, the market's at a downtrend. If you quickly flip over to a 1-hour chart, all of a sudden this looks very bullish. We had an aggressive move here to the upside. We pulled all the way back here. We bounced off this trend line here. We enjoyed our rally. We had a bit of a brief pullback again, only to move higher yet again. And the peak that we set here in the last few hours isn't too far away from the peak that was set here last week. So different time frames can show you a different picture. And I would strongly advise looking at multiple time frames. So whatever, for the person who asked me what chart are you looking at, do you mind if I ask you a question? What time frames do you typically look at when you're trading, or when you're basing a trading idea? What time frames do you typically look at? Because what I'm getting at is, if you use the, for example, the 1-hour chart when you're doing trading, I would always be keeping an eye what's going on the 4-hour chart and the day chart as well, and even the weekly chart as well, just to get a feel for the big picture trend. So what I'm getting at is, if you just look at, say, for example, a 15-minute chart or a half-an-hour chart or a 1-hour chart, you might look at that and glean from those various different from those time frames that the market's trending higher, and that things are going to get better, and you're in buy the dip mode if the market's trending higher. But if you just take a step back for a moment and take a look at a 4-hour chart, you're then going to go, this rally that it's been in for the past week or 10 days, as strong as it's been, it's a relatively small rally when compared with the colossal losses that have been suffered from early June all the way down to mid-July. So the market was in a fairly aggressive downward trend. The market was up around $122 a barrel in early June, and it fell to below $94 a barrel by mid-July. So it's suffered a sizable loss to the downside over a 5 or 6 week period, but now we've been rallying. And I think I kind of highlighted that fairly well, that you can, one picture, one time frame or a similar time frame will show you one picture, but also if you were to scope out to a 4-hour chart or even a daily chart, you can really see how things have actually changed. 15 minutes to a day chart. So yeah, exactly. I think that's quite a sensible strategy, and it also works both ways. So you might be looking at a 4-hour chart. You might be looking at a. Actually, what I'll do is, for the sake of this argument, I'll actually flip over to US oil, because I know I've no trend lines or whatever on US oil. The price action is quite similar. We had a very aggressive decline between early June and mid-July. Then we've had a pretty good rebound, but nothing amazing. Let's face it, the peaks that we've seen here still have yet to retest the peaks of last week. So if you say to yourself, look at a 4-hour chart, I'm going to buy the dip because you see the price action going on here. Then you zoom in to say a 1-hour chart and you go, this looks fairly aggressive, fairly bullish. Yet again, half an hour window will tell you something, and then a 15-minute window will tell you something again. So, and even a 5-minute window, they're always kind of trends within trends. So whatever the time frames you typically look at, I would always be looking at a couple of time frames either side of that, because if you look at typically use a 4-hour chart and you say to yourself, I want to buy the dip, it's something like a 1-hour chart or perhaps even a half-an-hour chart. That's the sort of thing which can actually fine-tune your trade, in terms of it can help you kind of pinpoint which exact level you might want to open a position at or close a position at. I'll be conscious that I've been speaking for about half an hour. Are there any other questions? Any markets that you want me to take a look at? I've already looked at gold, I've looked at oil, I've covered the S&P 500, I've covered pound dollar, and I've covered the FTSE 100, the UK 100, and not to mention the kind of big stories in the market in the past 24 hours. US being in a technical recession, and also the dovish hike from the Fed last night. Last call for any last questions. If you do have any questions, now's a good time to shout them out. Very quickly, what I'll do is I'll show off my Twitter feed. dmadden_equity is my Twitter handle, at dmadden_equity. I'm fairly active on Twitter. Obviously, we also have a FXPayza Twitter account as well, and not to mention equity, the overall equity brand as well. So feel free to get in touch with myself on Twitter. I can't or won't give you any advice over what to do in terms of trading ideas. But what I can do is discuss the markets in a similar fashion to what I discussed just there, whereby I talk about the prevailing trend of a market, I comment on what's going on with the indicators. I suggest I'll make comments like, if the prevailing trend continues, we could target prices A and B, and should we see reversal in prices, we could fall to levels X and Y. Natural gas. Let's just see if we actually. To be fair, natural gas is a market I would look at. I would look at NG2. Oh, my apologies. It looks as if that contract hasn't been updated, and that's why the price only goes as far as June. I think, apologies about that. It seems as if it's an older incorrect contract, and for some reason it hasn't actually been updated. I do want to apologize about that. Yes, that contract expired last month by the looks of it. I don't know why it hasn't actually automatically rolled over. For the individual, yes, silver. We'll happily take a look at silver. Now, before we take a look at silver, let's take a quick look at gold again. Remember, I was talking about Dow theory. I was talking about how the averages must confirm each other. Essentially, similar markets will move in theory, will move in a similar direction by a similar amount at the same time. This doesn't always hold up, but it's something to keep an eye on. What's going on with the price action of gold? We saw a sharp rebound from last week. We moved higher, we pulled back ever so slightly, and we've been moving aggressively higher in the past 24 hours. The weak dollar is helping silver. Sorry, the weak dollar is helping gold. And the last few hours, we've hit its highest level since early July. So we're talking about a 3.5, almost 4-week high being set on gold. Are we seeing something similar with silver? And the short answer is yes, we are. Even the price level I was literally penciling in for silver recently, up around 19 spot 90, and this recent, and the peak here just beyond 20 spot 19. We've cleared one of those targets. We're kind of quite close to the psychologically 20 mark. So we've aggressively higher here on silver. We're well above all 3 simple moving averages. Momentum is firmly in positive territory. That's a very aggressive move to the upside on the MACD indicator in terms of positive momentum. If this kind of bullish run continues, I'll be looking toward this peak here around 20 spot 19. And then going beyond that, and I'll be looking up towards this area here. This area here around 20 spot 70. Looking toward these kind of peaks along here around 20 spot 70, and then beyond that up towards 21. Now, what I will say this about silver, it's had such an aggressive move to the upside. We can see the RSI has moved firmly into overbought territory. So we could be in the kind of the phases of the upward move in silver being overcooked. Also, if you just look at the rate at which the market's gone up, that's, you know, if the market moves aggressively higher quite quickly, in theory, it could move aggressively lower quite quickly as well. Not always, but that can be the way. So if you do see a sharp move to the downside in silver, I'll be looking down toward this zone here around 19.30, then down towards 19.00 itself, and then potentially down towards, with these moving out in around the 20-period moving average, which comes into play at 1900, and then going below that down towards the last obvious low here before the market broke higher in at 18.43. Question here, how come the Dow Jones price is trending higher in spite of higher interest rates? Okay, in addition to that, please say no to the mouse. So quickly talk about the US 500, and then I'll look down to the other two markets, the Dow and the U200, and then I will look to wrap things up. So the US 500, why did the market move higher in the face of higher interest rates? Well, first of all, the US Federal Reserve signaled for a long time that they're going to hike interest rates by 75 basis points. So they did exactly that. So it was bang in line with expectations. So there was no shock there. Where there was a bit of a surprise, though, was when they talked about how certain economic reports in terms of consumer activity and production showed a softening of the economy, indicating they're a bit nervous about the economy. And then also the Federal Reserve said, although we are going to do more rate hikes, you know, some of the rate hikes that we have kind of mentally penciled in further down the line, they mightn't be 75 basis points, they could be smaller hikes. And with that, people then thought, oh, if you're going to be doing smaller hikes down the line, that's not as bad as what we all originally thought. That the consensus in the market, even a few weeks ago, was that they're going to be doing large hikes come September, even you know, a 75 basis point hike again in September, or maybe even a 100 basis point hike. So their signaling was that although we're going to be hiking rates, we're probably going to be actually doing the rate at which we're going to be hiking will probably decline, you know, a few months down the line or toward the end of the year. So that's why the US stock markets have been going higher despite a rate hike. Areas of potential support and resistance, you know, I covered the US 500 already, up around 41, 44, and then this peak here of early June at 41.89. Move to the downside, could find support. Well, first of all, 4,000 itself, big psychological number. And then second of all, this moving average here comes into play around 39.48. And then the last one, the big one to watch out for will be this last big obvious low here of 39.10. Looking at the UT100, the Nasdaq 100, so we've moved aggressively higher recently in the last few hours. 442. Similar situation with the US 500, the similar situation with the UT100. We've hit a highest level since mid-June, so we're talking about a kind of 6-7 week high being set. That in itself tells you how bullish the market is. If we continue to move higher from here, I'll be looking towards just north of 12,800, and then beyond that again up towards 12,941. If we do see a bit of a pullback in the UT100, where can we target? Well, back towards the recent lows here in around 12,444, 12,442, and drop below that could see us back down toward this zone here at 12,237. And lastly, coming on to the US 30, the Dow Jones. Similar situation to the Dow Jones. The market's been moving aggressively higher recently. We've recently hit a level last seen in mid-June, so the kind of broader trend is to the upside. If we continue to move higher from here, I'll be looking towards 32,824, and then beyond that, 33,000 will be the next big level to watch out for, big psychological number on the Dow. Move to the downside, well, I'll be looking towards this area here in around the low here at 31,977. So just below 37, just below 32,000 will be the kind of next big level to watch out for, 31,977. 31.9. So we're currently at around 32,540 odd points. If you do see a fairly large move to the downside, I'm looking towards this the last big low here before the market moved aggressively higher, and that comes into play just shy of 32,000 at 31,977. The very last, I got a question here about a reversal. Basically, to kind of show you, I wrote it in my in my analysis last week, and I believe I covered it in one of my videos. Essentially, a reversal is, put it very, very simply, where you have an aggressive move in the opposite direction. And if you take, for example, this is the gold chart here. I'll answer this question and then actually wrap things up. The gold market here was moving aggressively lower first off. You can see here that if you look at the low point here, the low of this candle here managed to break below the previous low. So it went on to set a new 11-month low. Then the market turned around and it moved aggressively higher. If you look at the body of this candle here, you can see here that it completely overshadows or eclipses or engulfs this red rectangle here. The previous candle was red, was a negative candle. That's why it's denoted as red. But it's a fraction of the size compared to this big positive one here. So the color of this candle here denotes that it was a upward move, and not only was it an upward move, the size of it, the body here is probably twice the size, if not twice and a half the size of the preceding candle. So that was a sign that this could be the beginning of a bullish reversal. It has to be confirmed. You can't just see a candle that shape there and go, aha, that's a bullish reversal or a bullish engulfing, as it's also known. I'd look up those two terms on technical analysis and reading about it. But the last point is, it needs to be confirmed. You need to see the market moving higher after that candle has been spotted. You can't just say, oh, I saw that candle, therefore the market's going to go higher. And sometimes you don't know how the market's going to play out. Sometimes there is a reversal whereby the market pulls back some of the ground that it lost on the way down. It does have a genuine reversal. It does move higher, but the move higher runs out of steam and the market moves lower. Sometimes the market has a reversal, or looks as if it's reversing. It continues to move higher, and then it keeps on going, like what we're seeing now. And it's one of those things. The more the market rallies from the possible zone or point of reversal, the more confident you can point at that was an actual reversal. I hope that answers the question in relation to the reversal. Now we're coming up to, I've almost been speaking now for about kind of 45 minutes. I'll look to wrap things up there. Once again, I do want to apologize for the slow start at the beginning. I do want to thank for all of you for tuning in, especially those of you who asked a few questions. It's always nice to have a bit more interaction. I feel like a two-way conversation rather than just me talking on a screen for kind of 45 minutes. So I'll be looking to wrap things up now. So everyone, have a good evening and see you next week. Thank you very much.